Rating 28, long-lived assets. Learning outcomes. The candidate should be able to distinguish between costs that are capitalized and costs that are expensed in a period in which they are incurred. Compare the financial reporting and the following types of intangible assets: purchased and internally developed, acquired, and business combinations. Explain and evaluate how capitalizing versus expensing costs in a period in which they are incurred after financial statements or ratios. Describe the different depreciation methods for property, plants, and equipment, and calculate depreciation expense. Describe how choices of depreciation methods or assumptions concerning useful life and residual value affect depreciation expense, financial statements, and ratios. Describe the different amortization methods for intangible assets with the finite level and calculate amortization expense. Describe how the choice of amortization method and assumption concerning useful life and residual value affect amortization expense, financial statements, and ratios. Describe the revaluation model. Explain the impairment of property, plants, and equipment and intangible assets. Explain the derecognition of property, plants, and equipment and intangible assets. Explain and evaluate how impairment, revaluation, and recognition of property, plants, equipment, and intangible assets affect financial statements and ratios. Describe the financial statement presentation of the closure relating to property, plants, and equipment of intangible assets. Analyze and interpret financial statement disclosing regarding property, plants, and equipment and intangible assets. Compare the financial reporting and investment property with the property, plant, and equipment. Explain and evaluate how leasing rather than purchasing assets affect financial statements and ratios. Explain and evaluate how financial leases and operating leases affect financial statements and ratios from the perspective of both the leaser and the leasee. Introduction. Long-lived assets, also referred to as non-current assets or long-term assets, are assets that are expected to provide economic benefit over a future period of time, especially greater than 1 year. Long-lived assets may be tangible, intangible, or financial assets. Example of long-lived tangible assets, typically referred to as property, plants, and equipment, are sometimes a fixed asset, include land, building, furniture, and fixtures, machinery and equipment, and vehicles. Examples of long-lived intangible assets include patents and trademarks, and examples of long-lived financial assets include investments in equity or debt, securities issued by other companies. The scope of this reading is limited to long-lived tangible and intangible assets, hereafter referred to simply as long-lived assets. The first issue in accounting for long-lived assets is determining its cost of acquisition. The second issue is how to allocate the cost to expense over time. The cost of most long-lived assets are capitalized, then allocated as expenses in the profit or income statements over the period of time during which they are expected to provide economic benefit. The two main types of long-lived assets with costs are typically not allocated over time or on land, which is not depreciated, and these interchangeable assets with indefinable useful lives. Additional uses that arise from the treatment of subsequent costs incurred related to the assets, the use of cost model versus revaluation models, unexpected declines in the value of the asset, classification of asset with respect to intent, and the recognition of the asset. This reading is organized as follows. Section 2 describes the illustration of accounting and acquisition of long-lived assets, with particular attention to the impact of capitalization versus expenditure. Section 3 describes the allocation of costs of long-lived assets over the useful lives. Section 4 discusses the revaluation model that is based on changes in the fair value of assets. Section 5 covers the concepts of impairment. Section 6 describes accounting and the recognition of the long-lived assets. Section 7 describes financial statement presentation, disclosures, and analysis of long-lived assets. Section 8 discusses differences in the financial reporting and investment property compared to property, plants, and equipment. Section 9 describes accounting for leases. A summary on following is followed by practice problems. Acquisition of long-lived assets. Upon acquisition, property, plant, and equipment are recorded on the balance sheet as costs, which is typically the same as the fair value. Accounting in the intangible assets depends on how the assets is incurred. If several assets are occurred as part of a group, the purchase price is allocated to each asset on the basis of its fair value. An asset's cost potentially includes expenditures additional to the purchase price. A key concept in accounting for expenditure related to long-lived asset is whether whether and when such expenditures are capitalized versus expenses. After examining the specific treatment of certain expenditures, we will consider the general financial statement impact on capitalizing versus expensing and two analytical issues relating to the decision. Namely, the effect on an individual company's trend analysis and the comparability across companies. Property, plant, and equipment. This section primarily discusses the accounting treatment of the acquisition of long-lived intangible assets. Through purchase, assets can be acquired by method other than purchase. When an asset is exchanged for another asset, the asset occurs as recorded at fair value if reliable measures of fair value exists. Fair value is the fair value of the asset given up unless the fair value of an asset occurred is more clearly evident. If there is no reliable measure of a fair value, when a property, plant, or equipment is purchased, the buyer records the asset of cost. In addition to the purchase price, the buyer also includes as part of the cost of asset all expenditures necessary to get the asset ready for intended use. For example, purchasing of a place for business is in specialized installations, and testing costs required to make the assets available are included in the total cost of the asset. Subsequent expenditures related to long-lived assets are included as part of the recorded value of the asset on the balance sheet. If they are expected to provide benefit beyond 1 year in the future, they are expensed. If not, they are expected to provide benefit in future periods. Expenditures that extend to original life of the asset are typically capitalized. Example 1 illustrates the difference between costs and the capitalized costs that are expensed in a period. Example 1 describes capitalizing versus expensing in the context of purchased property, plant, and equipment. When a company constructs an asset, borrowing costs incurred directly related to construction are generally capitalized. Constructing a building, whether for sale or for the company's own use, typically requires a substantial amount of time to finance constructions, and reborrowing costs incurred prior to the asset being ready for its intended use are capitalized as part of the cost of assets. The company determines the interest rate to use on the basis of existing borrowing or, if applicable, on borrowing specifically incurred for constructing the asset. If a company takes out a loan specifically to construct the building, the interest costs on the loan during that time of construction will be capitalized as part of the building cost. Under IFRS, both but not under US GAAP, income earned on temporary investing and borrowing monies decreases the amount of borrowing costs eligible for capitalization. Thus, a company's interest costs for a period are included either on a balance sheet or on an income statement. If the interest expenditures is incurred in connection with constructing an asset for a company's own use, the capitalized interest appears on the balance sheet as a part of the relevant long-lived assets. The capitalized interest is expensed over time as the property is depreciated and thus part of a subsequent year's depreciation expense rather than the interest expense of the current period. If the interest expenditure is incurred in connection with constructing the asset to sell, the capitalized interest appears on the company's balance sheet as part of inventory. The capitalized interest is expensed as part of the cost of goods sold when the asset is sold. Interest payments made prior to the completion of constructions are classified as an investing cash flow. Expense interest may be classified as an operating or financing cash outflow under IFRS and is classified as operating cash flow under US GAAP. Intangible assets. Intangible assets are assets lacking physical substance. Intangible assets include items that involve exclusive rights, such as patents, copyrights, and trademarks, and franchises. Under IFRS, identifiable intangible assets must meet 3 defined criteria. They must be 1, identifiable, 2, under the control of the company, and 3, expected to generate future economic benefit. In addition, 2 recognized criteria must be met. 1, it is probable that the expected future economic benefit of the asset will flow to the company. And two, the cost of the asset can be reliably measured. Goodwill, which is not considered an intangible asset, arises when one company purchases another and the acquisition price exceeds the fair value of the identifiable assets occurred. Accounting for an intangible asset depends on how it is acquired. The following section describes accounting for intangible assets obtained in three ways: purchased in situations other than business combinations, developed internally, and acquired in business combinations. Intangible assets purchased in situations other than business combinations. Intangible assets purchased in situations other than business combinations, such as buying a patent or treating an acquisition the same as long-lived assets. They are recorded at their fair value when acquired, which is accustomed to be equivalent to the purchase price. If several intangible assets are acquired as part of a group, the purchase price is allocated to each asset on the basis of fair value. In deciding how to treat individual intangible assets for analytical purposes, analysts are particularly aware that companies must use a substantial amount of judgment and numerous assumptions to determine a fair value of individual intangible assets for analysis. Therefore, understanding the type of intangible assets acquired can often be more useful than focusing on value assigned to the individual assets. In other words, an analyst would typically be more interested in understanding what assets a company can acquire than the precise proportions of the purchasing price of a company is allocated to each asset. Understanding the type of assets a company acquires can often offer insight into a company's strategic direction and future operation potential. Intangible assets development internally, in contrast with the treatment of construction costs of tangible assets. The costs of internally developed intangible assets are generally expensed when incurred. There are some situations, however, in which the costs incurred to internally develop and intangible assets are capitalized. The general analytical issues related to the capitalization versus expense decisions applying here, namely comparability across companies and the effect on the individual company's trend analysis. The general requirement that the cost to internally develop intangible assets be expensed should be compared with capitalizing the cost of acquiring intangible assets in situations other than business combinations, because costs associated with internally developed intangible assets are usually expensed. A cost that has internally developed such intangible assets as patents, copyrights, or brand through expenditures on R&D or advertisement will be recognized as lower amounts IFRS requires that expenditures on research be expensed rather than capitalized as intangible assets. Research is defined as original and planned investigation undertaken with prospect of gaining a new scientific or technical knowledge and understanding. The research phase of the internal project refers to the period during which a company cannot demonstrate that an intangible asset is being created. For example, the research of alternative materials or systems to use in the production process. IFRS allows companies to recognize an intangible asset arising from development if certain criteria are met, including a demonstration of technical feasibility of completing the intangible asset and the intent to use or sell the asset. Development is defined as the application of a research finding and other knowledge to the plan or design for the production of new or substantially improved materials, devices, products, processes, systems, or services before the start of commercial production or use. Generally, US GAAP requires that both research and development costs be expensed as incurred, but require capitalization of certain costs related to software development. Costs incurred to develop a software product for sale are expensed until the product's technological feasibility is established and are capitalized thereof. Similarly, companies expense costs related to the development of software for internal use until it is probable that the project will be complete and the software will be used as intended. Therefore, development costs are capitalized as probability that the project will complete is easier to demonstrate than technological feasibility. To capitalize costs related directly to development software for sale or internal use included the cost of employees who help build a test software. The treatment of software development costs under US GAAP is similar to the treatment of all costs of the intangible assets under IFRS. Intangible asset acquisitions in a business combination. When one company acquires another company, the transactions is accounted for using the acquisition model of accounting. Under the acquisition model, the company identifies the acquirers, allocates the purchase price to each asset acquired on the basis of fair value. If the purchase price exceeds the sum of the amount that can be allocated to individual identifiable assets and liabilities, the excess is recorded as goodwill. Goodwill cannot be identified separately from the business as a whole. Under IFRS, the acquisition and the acquired individual assets include identifiable intangible assets that meet the definitional and recognition criteria. Otherwise, if the item acquired in a business combination and cannot be recognized as an intangible or identifiable intangible asset, it is recognized as goodwill. Under US GAAP, there are two criteria to judge whether an intangible asset acquired in a business combination should be recognized separately from goodwill. The asset must either have must be either an item rising from the contractual or legal rights of an item that can be separated from the acquired company. Examples of intangible asset treatments are separate from goodwill. Intangible assets previously mentioned are patents, copyrights, franchise, license, etc. Capitalization versus expenses, impact of financial statements and ratios. This section discusses the impacts of financial statements and ratios, capitalizing versus expensing costs of the period which are incurred. The first summarizes the general financial statements impact of capitalization versus expenditures, and two analytical issues related to the decision, namely the effect of individual companies, trend analysis, and the comparability across companies. In the period of expenditure, the expenditure that are capitalized increases the amount of assets of the balance sheet and appears as an investigating cash flow of the statement of the cash flows. After initial recognition, a company reallocates the capitalized amount over the asset's useful life as depreciation or amortization expense. Alternatively, the expenditure that is expensed reduced net income by after-tax amounts, and expenditures is the period it is made. No assets is recorded on the balance sheet, and thus no depreciation or amortization occurred in subsequent periods. The lower amount of net income is reflected in lower retained earnings on the balance sheet, and expenditure that is expensed appeared as an operating cash flow in the period it is made. There is no effect on financial statements of subsequent periods. Example 4 illustrates the impact of financial statements on capitalizing versus expenditures. As shown, discretion regarding whether to expense the capitalized expenditures can impede comparability across companies. Example 4 assumes that companies purchase a single asset in 1 year because the sum of the net income over a 3 years period is identical whether the asset is capitalized or expected. It illustrates that although capitalizing results in higher profitability compared to expenses, in the first year, it results in lower profitability ratios. In the subsequent years, conversely, expensing results as lower in profitability in the first year, but higher profitability in the later years, indicative of favorable trends. Similarly, shareholders' equity for a company that capitalizes the expenditures will be higher in the earlier years because the initially higher profits result in higher retained earnings. Example 4 assumes that companies purchase a single asset in 1 year and report identical amounts of total net income over 3 years periods. So shareholders' equity will be identical to the shareholders' equity. Okay, so example 4. Okay. Compared to expensing an expenditure, capitalizing the expenditure typically results in greater amounts of reported cash flow from operations. Capitalized expenditures are typically treated as an investment cash flow, whereas expenses reduced operating cash flows because cash flows from operating activities is an important consideration in some valuation models. Companies may try to maximize reported cash flows from operating by capitalizing expenditures that should be expensed. Valuation models that use free cash flow will consider not only the operating cash flows but also investing cash flows. Analysts should be alert to evidence of companies manipulating reported cash flows from operations by capitalization expenditures that used to expense. In summary, holding all else constant, capitalizing an expenditure enhances current profitability and increases reported cash flow from operations. Capitalization of interest costs. Okay. Okay, I'm going to pause the reading right here and continue the reading next time. So I do hope my reading has been helpful, and I hope to see you guys in the next one. Good. Depreciation and amortization of long-lived assets. Under the cost model of the reporting long-lived assets, which is permitted under IFRS and required under US GAAP, the capitalized cost of long-lived intangible assets, other than land, which is not depreciatable, our intangible assets with finite useful lives are allocated to subsequent periods as depreciation and amortization expenses. Depreciation and amortization are effectively the same concept, with the term depreciation referring to the process of allocating tangible assets costs. The term amortization refers to the process of allocating intangible asset costs. And the term amortization, okay. The alternative model of reporting long-lived assets is the revaluation model, which is permitted under IFRS but not under US GAAP. Under the revaluation model, a company reports a long-lived assets at fair value rather than at the acquisition cost. Less accumulated appreciation or amortization as in the cost model. An asset's carrying amount is the amount of which the asset is reported on the balance sheet. Under the cost model, at any point at time, the carrying amount of the long-lived assets is equal to the historical cost minus the amount of depreciation of amortization that has been accumulated since the asset's purchase. Companies may present on the balance sheet the total or net amount of property, plant, and equipment, and total net amount of intangible assets. However, more detail is disclosed in the notes to financial statements. The details disclosed typically includes the acquisition cost, the depreciation and amortization expenses, the accumulated depreciation and amortization amounts, the appreciation and amortization methods used, and information on the assumption used to depreciate and amortize long-lived assets. Depreciation model and calculation of depreciation expense. Depreciation model includes the straight line model, in which the cost of an asset is allocated to expense evenly over its useful life. Accelerated models, in which the allocation of cost is greater in earlier years, and the unit of production method, in which the allocation of cost corresponds to the actual use of the asset in a particular period. The choice of depreciation method affects the amount reported in net income. This in turn affects the variety of financial ratios, including fixed assets turnover, total asset turnover, operating profit margins, operating returns on asset, and returns on asset. Using a straight line model, depreciation expense is calculated as depreciable cost divided by estimated useful life, and is the same for each period. Depreciable cost is the historical cost of the tangible asset minus the estimated residual or the salvage value. A common used accelerated model is the declining balance model in centrage of the carrying amount. When an accelerated model is used, depreciation cost is not used to calculate the depreciation expense, but the carrying amount should not be reduced below the estimated residual value of the per unit cost. The depreciation expense is calculated as depreciable cost type reduction in the period divided by estimated productive capacity over the life of the asset. Equivalently, the company may estimate the depreciation cost per unit and calculate depreciation expense as depreciation cost per unit times production in the period. Regardless of the depreciation method used, the carrying amount of the asset is not reduced below the estimated residual value. Example 8 provides an example of these depreciation models. In many countries, a company must use the same depreciation model for both financial and tax reporting. In other countries, including the United States, a company needs not use the same depreciation model for financial reporting and taxes. As a result of different depreciation models for financial and tax reporting. Pre-tax income on the income statement and taxable income on the tax return may differ. Thus, the amount of tax expense computed on the basis of pre-tax income and the amount of tax actually owned on the basis of taxable income may differ. Although these differences are eventually reversed because the total depreciation of is the same regardless of the timing and its recognition of financial statements versus the tax returns. During the period of the difference, the balance sheet will show what is known as deferred taxes. For instance, if a company, that's an example. Although no significant differences exist between IFRS and US GAAP with respect to different definition of depreciation and acceptable depreciation methods, IFRS require companies to use a component method of depreciation. Companies are required to separately depreciate the significant components of an asset. And thus require additional estimates for the various components. For instance, it may be appropriate to depreciate separately the engine, the frame, the interior furnishing of an aircraft. Under US GAAP, the component method of depreciation is allowed but seldom used in practice. The following example illustrates the depreciation components of an asset. Total depreciation expense may be allocated between the cost of sale and other expense within the income statement. Depreciation expense of asset used in production is usually allocated to cost of sales, and a depreciation expense of asset not used in the production may be allocated to some other expense category. For instance, depreciation expense may be allocated to selling general and administrative expenses if depreciable assets are used in those financial areas. In those functional areas, notes to the financial statements sometimes disclose information regarding which income statement lines items include depreciation expense, although the exact amount of detail disclosed by individual companies varies. Amortization methods and calculation of amortization expense. Amortization is similar in concept to depreciation. The term amortization applies to intangible assets, and the term depreciation applies to tangible assets. The term depreciation applies to intangible. Both terms refer to the process of allocating cost of an asset over the asset's useful life. Only those intangible assets assumed to have a finite useful lives are amortized over the useful lives. Following the pattern in which the benefits are used up, acceptable amortization methods are the same as the method acceptable for depreciation. Assets assumed to have the indefinite useful life, in other words, without finite useful life, are not amortized. An intangible asset is considered to have indefinite finite life if it is not foreseeable limit to the period over which the asset is expected to generate net cash flow for a company. Intangible assets with finite lives include acquired customer lists expected to provide benefit to the direct mail market company for 2 to 3 years. An acquired patent or copyright with significant expiration dates, an acquired license with a specific expiration date with no right to renew the license, and an acquired trademark for the production of a company plan that phases out a specific number of years. Examples of intangible assets with definite useful lives include an acquired license that, although it has a specific expiration date, can be renewed at little or no cost, and an acquired trademark that, although it has a specific expiration, can be renewed at a minimal cost and relates to the product that a company plans to continue selling or for the foreseeable future. As with depreciation for a tangible asset, the calculation of amortization for an intangible asset requires the original amount at which the intangible asset is recognized and estimates of the length of its useful life and its residual value at the end of its useful life. Useful lives are estimated on the basis of expected use of the asset, considering any factors that may limit the life of an asset, such as legal, regulatory, contractual, competitive, or economic factors. The revaluation model. The revaluation model is an alternative to the cost model for a periodic valuation and reporting for long-lived assets. IFRS permits the use of either the revaluation model or the cost model, but the revaluation model is not allowed under US GAAP. Revaluation changes the carrying amount for classes of long-lived assets to fair value. Under the cost model, carrying amounts are historical costs less accumulated depreciation or amortization. Under the revaluation model, carrying amounts are the fair value of the date at the date of revaluation less than any subsequent accumulated depreciation or amortization. Let me drink my hot chocolate. It's kind of sweet. IFRS allows companies to value long-lived assets either under a cost model as historical cost minus accumulated depreciation or amortization, or under a revaluation model at fair value. In contrast, U.S. accounting standards require that the cost model be used. A key difference between the two models is that the cost model allows only decreases in the value of long-lived assets compared with historical costs, but the revaluation model may result in increases in the values of long-lived assets to amounts greater than historical costs. IFRS allows a company to use the cost model for some classes of assets and a revaluation model for others, but the company must apply the same model to all assets within a particular class of assets and must revalue all of them within a class to avoid selective revaluation. Examples of different classes of assets include land and buildings, machinery, motor vehicles, furniture, and fixtures. The office equipment. The revaluation model may be used for classes of intangible assets, but only if an active market for an asset exists, because the revaluation model may only be used if its fair value of its assets can be measured reliably. For practical purposes, the revaluation model is rarely used for either tangible or intangible assets, but the use is especially rare for intangible assets. Under the revaluation model, whether an asset revaluation affects earnings depend on whether the revaluation initially increases or decreases an asset's class carrying amount. If a revaluation initially decreases a carrying amount of an asset class, the decrease is recognized in profit or loss. Later, if the carrying amount of the asset class increases, the increase is recognized in the profit or loss to the extent of its reverses. A revaluation decrease of the same asset class previously recognized in profit or loss, any increase in excess of the reversal amount would not be recognized. Asset revaluation offers several considerations for financial statement analysis. First, an increase in carrying amount of depreciatable long-lived asset increases total assets and shareholders' equity. So asset revaluation that increases the carrying amount of an asset can be used to reduce reported leverage. Defining leverage as average total asset divided by average shareholders' equity, increasing both the numerator, the assets, and the denominator, the equity. By the same amount of leads to declines in the ratios. Therefore, the leverage motivation for the revaluation should be considered in an analysis. For example, a company may revalue assets up if it is seeking new capital or approachingly leverage limitations set by financial covenants. Second, asset revaluation that decreases the carrying amount of the asset reduces net income. In the years of revaluation, profitability measures such as returns on assets and returns on equity declines. However, because total assets and shareholders' equity are also lower, the company may appear more profitable in future years. Additionally, reversal of downward revaluation also goes through income, thus increasing earnings. Managers can then opportunistically time the reversal of manage earnings to increase income. Third, asset revaluations that increase the carrying amount of an asset initially increases depreciation expense, total assets, and shareholders' equity. Therefore, profitability measures such as return on assets and equity returns would decline, although upwards assets revaluation also generates decreased income. The increase in valuation of long-lived Finally, the analyst could consider who did the appraisal, i.e. the independent external appraiser or management, and how often revaluation is made. Appraisers of the fair value of long-lived assets involve considerable judgment and discretion. Presumably, appraisals of net of assets from independent external sources are more reliable. How often assets are revalued can provide an indicator of whether the reported value continues to be representative of the fair value. The next two examples illustrate revaluation of long-lived assets under IFRS. Example 6 provides an example of a company's disclosure concerning revaluation. The exhibit shows an expert from 2006 from 2006's annual report of KPN, a Dutch telecommunication multimedia company. The expert is from the selection of the annual report in which the company explains differences between its reporting under IFRS and its reporting under US GAAP. One of these differences used previously noted is the US GAAP does not allow revaluation of fixed assets held for use. KPN elected to report a class of fixed assets to fair value and explain that under US GAAP, using the cost model, the value of its class at the end of 2006 would have been 350 million lower. Clearly, the use of revaluation model as opposed to the cost model can have a significant impact on the financial statement of companies. This can potentially consequences for company financial performance using financial ratios and companies that use different models. Let me drink my hot cocoa. Impairment of assets. In contrast with depreciation, the amortization charges, which serve to allocate the depreciable cost of long-lived assets over its useful life. Impairment charges reflect the unanticipated decline in the value of an asset. Both IFRS and US GAAP requires companies to write down the carrying amount of impaired assets. Impairment reversals for identifiable long-lived assets are permitted under IFRS, but typically not under US GAAP. An asset is considerable to be impaired when its carrying amount exceeds the recoverable amount. Under US GAAP, however, impairment losses are only recognizable when the carrying amount of the impaired assets is determined to be not recoverable. Therefore, in general, impairment losses is recognized when the asset's carrying amount is not recoverable. However, IFRS and US GAAP define recoverability differently. The following paragraphs describe accounting for impairment for different categories of assets. Impairment of property, plant, and equipment. Accounting standards do not require that property, plant, and equipment be tested annually for impairment. Rather, that at the end of each reporting period, a company assesses whether there are indications of asset impairments. If there is no indication of impairments, the asset is not tested for impairments. If there is indications of impairments, such as evidence of obscene declines in demand for products or technology advancements, the recoverable amounts of this asset should be measured in order to test for impairments for property, plants, and assets should be managed in order to test for impairments for property, plants, and equipment. Impairment losses are recognized when the asset's carrying amount is not recoverable. The carrying amount is more than the recoverable amount. The amount of the impairment loss will reduce the carrying amount of the assets on the balance sheet and will reduce net income on the income statement. The impairment loss is a non-cash item and will not affect the cash from operations. IFRS and US GAAP differs somewhat, both in guidelines and determination. In determining that impairment has occurred and in the measurement of an impairment loss under IAS 36, an impairment loss is measured as an excess of carrying amount over the recoverable amount of the asset. The recoverable amount of an asset is defined as the higher the fair value less cost to sell its value in use. Value in use is a discounted measure of expected future cash flows. Under US GAAP, assessing recoverability is separate from measuring the impairment loss. An asset's carrying amount is considered not recoverable when it exceeds the undiscounted expected future cash flows. If the asset's carrying amount is considered not recoverable, the impairment loss is measured as the difference between the asset's fair value and carrying amount. An example of 13, a write-down in the value of a piece of property, plant, and equipment occurred under IFRS but not under US GAAP. In example 14, a write-down occurred under both IFRS and US GAAP. Example 14 shows that the write up to value is used under IFRS can be less than the write down to fair value under US GAAP. The difference in recognition of impairment losses is ultimately reflected in differences between book value of equity. 5.2, impairment of intangible assets with a finite life. Intangible assets with finite life are amortized and may be impaired. As is the case with property, plants, and equipment, the assets are not tested annually for impairment. Instead, they are tested only when significant events suggest a need to test the company's asset at the end of each significant event suggests the need to test a company's assets at the end of each reporting period, whether a significant event suggesting the need to test for impairment has occurred. Examples of such event include a significant decrease in the market price or significant adverse change in legal or economic factors. Impairment accounting for intangible assets with a finite life is essentially the same as for tangible assets. The amount of the impairment loss will reduce the carrying amount of the asset on the balance sheet and will reduce the net income on the income statement. Impairment of intangibles with indefinite lives. Intangible assets with indefinite lives are not amortized. Instead, they are carried on the balance sheet at historical cost, but are tested at least annually for impairments. Impairment exists when the carrying amount exceeds its fair value. Impairment of long-lived assets held for sale. A long-lived asset or non-current asset is reclassified as held for sale rather than held for use when it ceases to be used by the management's intent is to sell it. For instance, if a building ceases to be used and management's intent is to sell it, the building is reclassified as property, plant, and equipment and non-current assets for sale. As for the time of reclassification, assets previously held for use are tested for impairment. If the carrying amount at the time of reclassification exceeds the fair value, less cost to sell, the impairment loss is recognized and the assets written down as fair value. Less cost to sell, long-lived assets held for sale cease to be depreciated or amortized. Reversals of impairment of long-lived assets. After an asset has been deemed impaired and an impairment loss has been reported, the asset's recoverable amount could potentially increase. For instance, a lawsuit appeal may be successfully change a patent infringement by another company. With the result of the patent previously written down by higher recoverable amounts, IFRS permits impairment losses to be reversed if the recoverable amount of the assets increases regardless of whether the asset is classed as held for use or held for sale. Note that IFRS permits the reversal of impairment losses only. IFRS does not permit the revaluation to the recoverable amount if the recoverable amount exceeds the previous carrying amount. Under US GAAP, the accounting for reversal of impairment depends on whether the asset is classified as held for use or held for sale. Under US GAAP, once the impairment loss has been recognized for assets held for use, it cannot be reversed. In other words, once the asset held for use has been decreased by any impairment charges, it cannot be increased for assets held for sale. If the fair value increased after its impairment loss, the loss can be reversed. Derecognition. Company derecognizes an asset when the asset is disposed of, or if the expected to provide no future benefit from either a use or disposal. A company may dispose of a long-lived operating asset by selling it, exchanging it, or abandoning it. As previously described, non-current assets that are no longer in use are to be sold or reclassified as non-current assets held for sale. Sale of long-lived assets, the gain or loss of the sale of long-lived assets is computed as the sales proceed minus the carrying amount of the asset at the time of sale, and assets carrying amount is typically the net book value, unless the assets carrying amount has been changed to reflect the impairment and or revaluation as previously discussed. A gain or loss on the sale of an asset is disclosed on an income statement, either as a component of other gains and losses or in a separate line item when the amount is material. A company typically discloses further detail about the sale in the management decisions and analysis of the financial statement footnote. In addition, a statement of cash flow prepared using the indirect method adjusts net income to remove any gains or loss on the sales from operating cash flows and to include the amount of proceeds from the sales in cash from investing activities. Recall that the indirect method of the statement of the cash flow begins with net income and makes all adjustments to arrive at cash flow from operations, including removal of gains or losses from non-operating activities. Long-lived assets disposed of others by a sale. Long-lived assets to be disposed of by others other than by a sale are classified as held for use until disposal. Thus, the long-lived assets continues to be depreciated and tested for impairments unless their carrying amount is zero, as required for the long-lived assets owned by the company, When an asset is retired or abandoned, the accounting is similar to a sale, except that the company does not record cash proceeds as assets are reduced by the carrying amount of the asset at the time of the retirement or abandonment, and a loss equal to the asset's carrying amount is recorded. When an asset is exchanged, accounting for the exchange typically involves removing the carrying amount of the assets given up, adding a fair value of the assets acquired, and then reporting any differences between the carrying amount and the fair value as a gain or loss. The fair value used for the assets given up unless the fair value of the asset acquired is more clearly evident. If no reliable measures of fair value exist, the acquired asset is measured at the carrying amount of the asset given up. A gain is reported when the fair value used for the newly acquired asset exceeds the carrying amount of the asset given up. A loss is reported when the fair value used for the newly acquired asset is less than the carrying amount of the assets given up. If the acquired asset is valued at the carrying amount of the asset given up, because no reliable measures of fair value exist, no gains or losses reported. When a spin-off occurs, typically an entire cash-generating unit of a company with all its assets are spun off. An illustration of a spin-off as follows. Okay. Presentation and disclosures under IFRS. For each class of property, plants, and equipment, a company must disclose the measurement basis and depreciation method and the useful lives. Use the gross carrying amount and the accumulated depreciation at the beginning of the end of the period, and a reconciliation of the carrying amount at the beginning and end of the period. In addition, disclosures are restrictions. Disclosures or restrictions on title and pledges are secretly a security of property, plants, and equipment, and contractual agreements and acquired property, plants, and equipment are required. If the revaluation model is used, the dates of revaluation, details of how the fair value was obtained, and carrying amount under the class model, and the revaluation surplus must be disclosed. The disclosure requirements under US GAAP is less exhaustive. Under IFRS, each class of intangible assets, a company must disclose whether the useful life is indefinite or finite. If finite for each class of intangible assets, a company must disclose the useful lives used to amortization methods used, the gross carrying amounts, and accumulated amortization at the beginning of the end of the period, when amortization is included on the income statement, and a reconciliation of the carrying amount at the beginning and end of the period. If an asset has an indefinite life, a company must disclose the carrying amount of the assets and why it is considered to have an indefinite life, similar to property, plant, and equipment. Disclosures of restrictions on title and pledges as security of intangible assets are contractual agreements to acquire intangible assets are required. If the valuation model is used, the date of revaluation, details of how the fair value was obtained, the carry amount under the cost model, and the revaluation surplus must be disclosed. Under US GAAP, companies are required to disclose their gross carrying amount and accumulated amortization in total and by major class of intangible assets and aggregate amortization expenses for the period, and the estimated amortization expense for the next 5 fiscal years. The disclosures related to impairment losses also differ under IFRS and US GAAP. Under IFRS, a company must disclose for each class of assets the amounts of impairment losses and reversals of impairment losses recognized in the period, and where those are recognized on a financial statement. The company must also disclose in aggregate the main classes of assets affected by impairments, losses and reversals of impairment losses, and the main events and circumstances leading to recognition of these impairment losses and reversals of impairment losses. Under US GAAP, there is no reversal of impairment losses. The company must disclose a description of the impaired assets, or what led to the impairment, the method of determining the fair value, and the amount of impairment losses, and where the loss is recognized on the financial statement. Disclosures about long-lived assets appears throughout the financial statement, in the balance sheet, the income statement, the statement of cash flow, and the notes. The balance sheet reports the carrying value of the asset. For the income statement, depreciation expense may or may not appear as a separate line item. Under IFRS, whether the income statement discloses depreciation expense separately depends on whether the company is using a nature of expense method or a function of expense method. Under the nature of expense method, a company has aggregate expense according to their nature, and does not reallocate them among the functions within the entity. Under the functions of expense method, a company classifies expenses according to the function, for example, as part of cost of sales or SG&A. At a minimum, a company uses the function of expense method must disclose the cost of sales, but the line item varies. The statement of cash flow reflects acquisition and disposals of fixed assets in the investing section. In addition, when prepared using indirect method, the statement of cash flow typically shows depreciation expense. As the line item is in the adjustment of the net income to cash flow from operations, the notes to the financial statement describes the company's accounting method, the range of estimates useful lives, historical cost by main category of fixed asset, accumulated depreciation, and annual appreciation expense. To illustrate financial statement presentation and disclosure, the following example provides excerpts relating to the intangible asset of property, plant, and equipment for Vodafone Group for the year 2009. Note that the exhibits of the previous example contains relatively brief excerpts from the company's disclosures, and the complete text of the disclosure concerning the company's non-current assets spans several different footnotes, most of which are several pages long, in addition to information about the different rates and other assumptions used in calculating impairment changes. The disclosures provide information about the sensitivity of impairment changes to changes in assumptions. Overall, an analyst can use the disclosures to understand a company's investment in tangible and intangible assets, how these investments change during a reporting period, how these changes affect current performance, and what those changes might indicate about future performance. Ratios used in analyzing fixed assets include the fixed assets turnover ratio and several assets age ratios. The fixed asset turnover ratio reflects the relationship between total revenue and investment in PPE. The higher the ratio, the higher the amount of sales a company is able to generate with a given amount of investment in fixed assets. A higher asset turnover ratio is often interpreted as an indicator of greater efficiency. Asset age ratios generally rely on the relationship between historical cost and depreciation. Under the revaluation model, the relationship between carrying amount, accumulated depreciation, and depreciation expense will differ when the carrying amount differs significantly from the depreciated historical cost. Therefore, the following discussion of asset age ratios applies primarily. The PPE reported under the cost model, asset age and remaining useful life, two asset age ratios, the important indicators of a company's needs to reinvest its productive capacity. The older the asset and the shorter the remaining life, the more a company may need to reinvest to maintain productive capacity. The average age of a company's asset base can also be accumulated depreciation divided by appreciation expense. The average remaining life of a company's asset base can be estimated as the net PPE divided by the depreciation expense. These estimates simply reflect the following relationship for asset accounted for own historical cost basis. Total historical cost minus accumulated depreciation equals net PPE. In other straight line depreciation, total historical cost less salvage value divided by the estimated useful life equals annual depreciation expense. Equivalently, total historical cost less salvage value divided by annual depreciation expense equals estimated useful life. Assuming straight line depreciation and no salvage value, we have the following. The appreciation of these estimates can be illustrated by hypothetical examples of a company with a single depreciation asset. Assume the asset initially cost $100, had an estimate useful life of 10 years, and the valuation and the estimate salvage value of 0. Each year, the company records a depreciation expense of $10. So accumulated depreciation will equal $10 as the number of years since the asset was acquired. When the asset is 6 years old, the depreciation will be $70. Equivalently, the age of the asset will equal accumulated depreciation divided by the annual depreciation expense. In practice, such estimates are difficult to make with great precision. Companies use depreciation methods other than straight line methods, and have numerous assets with varying useful lives and salvage values, including some assets that are fully depreciated. So this approach produces an estimate only. Moreover, fixed assets disclosures are often quite general. Consequently, these amounts may be primarily useful to identify areas for further investigation. One further measure compares on companies' current reinvestment in productive capacity. Comparing annual capital expenditure to annual depreciation expense provides an indication of whether productive capacity is being maintained. It is a very general indicator of the rate of which a company is replacing its PPE relative to the rate of the PPE is being depreciated. Investment property. Investment property is defined under IFRS as property that is owned for the purposes of earning rental or capital appreciation or both. For example, the investment property is a building owned by a company and leased out to tenants. In contrast, other long-lived tangible assets are owner-occupied properties used for producing the company's goods and services, or for housing the company's administrative activities. Investment properties do not include long-lived tangible assets held for sale in the ordinary course of business. For example, the house and property owned by housing construction companies are considered to be inventory. Under IFRS, companies are allowed to value investment properties using either a cost model or a fair value model. The cost model is identical to the cost model used for property, plant, and equipment. If the cost model is used, the fair value of investment property must be disclosed. The fair value model, however, differs from the revaluation model used for property, plants, and equipment. Under the revaluation model, whether an asset revaluation affects net income depends on whether the revaluation initially increases or decreases the carrying amount of the asset. In contrast, under the fair value model, all changes in fair value of the asset affects net income. To use the fair value model, a company must be able to reliably determine the property's fair value on a continuing basis. Example 18 presents an expert from the annual reporting of the property company under IFRS. In general, a company must apply its chosen model to all of its investment property. If a company chooses the fair value model of its investment property, it must continue to use the fair value model until it disposes of the property or charges it use such as is no longer considered investment property. The company must continue to use fair value models for that property, even if transactions or comparable properties used to estimate fair value becomes less frequent. Certain valuation issues arises when a company charges to use the use of property, such as it moves being investment property to owner-occupied property or part of an inventory. If a company's chosen model for investment property is the cost model, such transfers do not change the carrying amount of the property transferred. If a company's chosen model is the fair value model, transfers from investment property to owner-occupied property or to inventory are made at fair value. In other words, the property's fair value at the time of transfer is considered to be its cost of ongoing accounting, the fair value model, and it transfers a property from owner-occupied to investment property. The change in measurement of the property from depreciated cost to fair value is treated like a revaluation. If a company's chosen model is the fair value model and it transfers a property from inventory to investment property, any differences between the inventory carrying amount and the property's fair value at the time of transfer is recognized as profit or loss. Investment property appears as a separate line item on the balance sheet. Companies all are required to disclose whether they use the fair value model or the cost model for the investment property. If the company uses the fair value model, it must make additional disclosures about how it determines fair value. It must provide reconciliation between the beginning and the ending carrying amounts of the investment property. If the company uses the cost model, it must make additional disclosures similar to those of the property, plant, and equipment. For example, the depreciation method and useful lives must be disclosed. In addition, if the company uses the cost model, it must also disclose the fair value of investment property. Under US GAAP, there is no specific definition of investment property. Most operating companies and real estate companies in the United States that hold investment property use historical cost models. Leasing is a contract between the owner of the asset. Let me drink my hot cocoa real fast. A lease is a contract between the owner of an asset, the leaser, and another party seeking to use the asset, the leasee. That's a funny word, leasee. Through the lease, the leaser grants the right to use the asset. To the leasee, the right to use the asset can be long periods, such as 20 years, or much shorter periods, such as a month. In exchange for the right to use the asset, the leasee makes a periodic lease payment to the leaser. A lease then is a form of financing to the leasee provided by the investor that enables the leasee to purchase and use the leased assets. The lease versus buy decision. There are several advantages to leasing an asset compared to purchasing it. Leases can provide less costly financing, usually require little, if any, down payment, and are often at fixed interest rates. The negotiated lease contract may contain less restrictive provisions than other forms of borrowing. A lease can also reduce the risk of obsolescence, residential value, and disposition of the leasee. Because the leasee does not own the assets, the leaser may be better positioned to manage servicing and assets and to take advantage of tax benefits of ownership. As a result, leasing the asset may be less costly than owning the asset for the leasee. Leases also have perceived financial and tax reporting advantages while providing a form of financing. Certain types of leases are not reported as debts on the balance sheet. The item leased under these types of leases also do not appear as assets on the balance sheet. Therefore, no interest expenses or depreciation expense is included in the income statement. Additionally, in some countries, such as the United States, financial reporting standards may differ from reporting under tax regulations. Thus, in some cases, a company may own an asset for tax purposes while not reflecting the ownership in its financial statement. A lease that is structured to provide a company with the tax benefit of ownership while not requiring the asset to be reflected on a company's financial statements is known as the synthetic lease. Finance versus operating lease. The difference in economic substance and accounting have traditionally existed for two main types of leases: finance and operating. The economic substance of finance or capital lease can be regarded as different from the operating lease, and are the implications of each of the financial statements of the leasee and the leaser. And substance of a financial lease is equivalent to the purchase of an asset by the buyer and directly financed by the seller. An operating lease is an agreement allowing the leasee to use the asset for a period of time, similar to a rental. Under previous international accounting standards, if substantially all the risk and reward incidental to ownership are transferred to the leasee, the lease was classified as a finance lease. In other words, the leasee was reported as an operating lease. Under the new international accounting standards, IFRS 16, the leasee is required to recognize leases of more than 12 months duration and a balance sheet, and the leasee can no longer classify the lease as an operating lease. The leaser continues to classify its lease as operating for financial leases under IFRS 16, while similar principle transfer both to US GAAP. Accounting and reporting by the lease. A financial lease has traditionally been viewed as economically similar to borrowing money and buying an asset. Therefore, a company that enters into financial lease as the lessee reports an asset and a related debt on the balance sheets. The initial value of both the leased asset and the lease payable is the lower of the fair value of the lease assets or the present value of future lease payments. On the income statement, the company reports interest expense on the debt, and if the asset acquired is depreciable, the company reports depreciation expense. An operating lease has been viewed as economically similar to renting an asset, so the lessee can record a lease expense on its income statement during the period the use with no asset or liability recorded on its balance sheet. The main accounting differences between a finance lease and an operating lease are that under a finance lease, reporting the debt and assets are higher and expenses are generally higher in the earlier years. Because of higher reported assets, debt, and expenses, therefore lower ROAs, whereas equal leases have often preferred operating leases to finance leases. As we illustrate in the next section, leasers' preferences generally differ. Leasers would perform a finance lease because under operating lease, leasers continue to show the asset and its associated financing on its balance sheet. On the lessee's statement of cash flow for an operating lease, the full lease payment is shown as an operating cash flow. For a finance lease, only a portion of the lease payments relating to the interest expense potentially reduces operating cash flow. The portion of its lease payments that reduces the lease liability appears as a cash output or outflow in the financing section. A company reporting a lease as an operating lease will typically show a higher profit in earlier years, higher return measures in earlier years, and a stronger solvency positions than an identical company reporting an identical lease as a finance lease. However, the company reporting the lease as a finance lease will show higher operating cash flows because a portion of the lease payments will be reflected as the financing cash outflows rather than an operating cash outflow. The following example illustrates the effect of a lessee's income, debt, and cash flows when reporting a lease as a financial lease, versus an operating lease. Example 20 uses current US GAAP and the recognition of operating leases. In summary, a company reporting a lease as an operating lease will typically show higher profits in earlier years, higher returns measured in early years, and a stronger solvency position than an identical company reporting an identical lease as a finance lease. However, the company reporting a lease as a financial lease will show higher operating cash flows because a portion of the lease payments will be reflected as the financing cash outflows rather than operating cash outflows. Let me drink my hot cocoa. The precisely defined accounting standard in the United States that determines when a company should report a finance or capital versus an operating lease enables a company to structure a lease so to avoid meeting any of the four capital lease criteria and thereby report an operating lease. Similar to debt disclosures, lease disclosures show payments under both capital and operating leases for the next 5 years and afterwards. Future payments under US GAAP are disclosed year by year for the first 5 years and then aggregate for all subsequent years. Under IFRS, future payments are disclosed for the first year and aggregate for years 2 through 5 and then an aggregate for all subsequent years. These disclosures can help estimate the extent of a company's off-balance sheet lease financing through the operating lease. Example 21 illustrates the disclosures under current US GAAP and how these disclosures can be used to determine the effects of financial statements if all operating leases were capitalized as under IFRS 16. Accounting and reporting by the lessor that report under USGAP. Whether a lease is financed or called capital lease or operating lease using the same four criteria as a lessee plus additional revenue recognition criteria. If a leaser enters into an operating lease, the lessor record any lease revenue when earned. The leaser also continues to report the leased asset on the balance sheet and the assets associated depreciation and expense on the income statement. Under a financial lease, the leaser reports a lease receivable based on the present value of the future lease payments, and the leaser also reduces the asset by the carrying amount of the asset leased. Under both USGAP and IFRS, the carrying amount of assets leased relative to the present value of the lease payments distinguishes direct financing lease from a sales type lease. The income statement will show interest revenue on the lease. USGAP makes a further distinction in defining two types of non-operating leases: direct financing leases and sales type leases. From the leaser's perspective, the direct financing lease result when present value of the lease payment and the amount recorded by the lease receivables equal the carrying amount of the leased asset. Because there is no profit on the asset itself, the leaser is essentially providing financing to the lessee, and the revenues earned by the leaser are financing in nature. If, however, the present value of lease payments exceed the carrying value of the leased asset, the lease is treated as a sale. When a company enters into sales type leases, a lease agreement where the present value of lease payments is greater than the value of leased assets to the leaser, it will show a profit on the transaction in the year of inception and interest revenue over the life of the lease. Summary: understanding the reporting of long-lived assets at inception requires distinguishing between expenditure that are capitalized and those that are expensed. Once a long-lived asset is recognized, it is reported upon the cost model as its historical cost less accumulated depreciation and less any impairment, or under the revaluation model and its fair value. IFRS permits the use of either the cost model or the revaluation model, whereas USGAP requires the use of the cost model. Most companies reporting under IFRS use the cost model. The choice of different models to depreciate, amortize long-lived assets can create challenges for analysts comparing companies. Key points include the following: expenditures related to long-lived assets are capitalized as part of the cost of assets if they are expected to provide future benefit, typically beyond 1 year. Otherwise, the expected related to long-lived assets are expensed as incurred, although capitalizing expenditures rather than expensing them. Result in higher reported profitability in the initial year. It results in lower profitability in subsequent years. However, if a company continues to purchase similar or increasing amounts of the asset each year, the profitability enhancing effect of capitalization continues. Capitalizing an expenditure rather than an expensing, it results in a greater amount of reported as cash flow from operating, because capitalized expenditures are classified as an investing cash outflow rather than operating cash outflow. Companies must capitalize interest costs associated with acquiring the construction or constructing an asset that requires a long period of time to prepare it for its intended use, including capitalized interest in the calculation of interest coverage ratio provides a better assessment of a company's solvency. IFRS requires research costs be expensed but allows all development costs to be capitalized under certain conditions. Generally, USGA under U.S. accounting standards requires that research and development costs be expensed. However, certain costs related to software development are required to be capitalized. When one company acquires another company, their transaction is accounted for using the acquisition model of accounting, in which the company identified as an acquirer allocates the purchase price to each asset acquired on the basis of its fair value. Under acquisition accounting, if the purchase price of an acquisition exceeds the sum of the amounts that can be allocated to individual identifiable assets and liabilities, the access of records as goodwill. The capitalized cost of long-lived tangible assets and intangible assets with finite lives used are allocated to expense in subsequent periods over their useful lives. For tangible assets, the process is referred to as depreciation, and for intangible assets, is referred to as amortization. Long-lived tangible assets and intangible assets with finite lives are reviewed for impairment, whether changes in events or circumstances indicate that the carrying amount of an asset may not be recoverable. Intangible assets with an indefinite useful life are not amortized but are reviewed for impairment annually. Impairment disclosures can provide useful information about a company's expected cash flow. Methods of calculating depreciation or amortization expense include a straight line method, in which the cost of an asset is allocated to expense in equal amounts each year over the useful life acceleration model, in which the allocation is greater in earlier years, and the unit of production method, in which the allocation corresponds to the actual use of an asset in a particular period. Estimates required for depreciation and amortization calculations include the useful life of equipment and its expected residual value at the end of its useful life. A longer useful life and a higher expected residual value results in smaller amounts of annual depreciation relative to a shorter useful life and lower expected residual value. IFRS permits the use of either the cost model or the revaluation model for the valuation and reporting of long-lived assets, but the revaluation model is not allowed under US GAAP. Under the revaluation model, carrying amounts are the fair value and the date of a revaluation, less any subsequent accumulated depreciation or amortization. In contrast with depreciation, the amortization charges which serves to allocate the cost of long-lived assets over the useful life. Impairment charges reflect an unexpected decline in the fair value of an asset to an amount lower than its carrying amount. IFRS permits impairment losses to be reversed with a reversal reported in profit. US GAAP does not permit the reversal of impairment losses. The gains or loss on sales of long-lived assets is computed as the sale proceed minus the carrying amount of the asset at time of sale. Estimates of average age and remaining useful life of a company's asset reflects the relationship between the asset accounted for on a historical cost basis and depreciation amounts. The average remaining useful life of a company's asset can be estimated as net PP&E divided by depreciation expense, although the accounting useful life may not necessarily correspond to the economic useful life. Long-lived assets are reclassified as held for sale, cease to be depreciated for amortization, or amortized. Long-lived assets to be disposed of others than by sale, e.g. abandoned, exchange for another asset, distribution of owners and a spin-off are classified as held for use until disposal. Thus, they continue to be depreciated and tested for impairments. Investment property is defined as a property that is owned for the property of earning rentals, capital appreciation, or both. Under IFRS, the companies are allowed to value investment properties using either a cost model or a fair value model. The cost model is identical to the cost model used for property, plants, and equipment, but the fair value model differs from the revaluation model used for property, plants, and equipment. Under the fair value model, all changes in the fair value of investment property affects net income. Under US GAAP, investment property are generally measured using the cost model. Accounting standards has traditionally defined two types of leases, operating lease and finance or capital leases. US GAAP specifies 4 criteria to determine whether a lease is classified as capital lease Although proposed standards will eliminate these specific criteria, IFRS has been less prescriptive in determining the classification of the lease of a financial lease. The new IFRS 16 requires that both operating lease and financial lease are recognized and accounting for finance leases by the lessee. When a lessee reports a lease as an operating lease rather than financial lease, it usually appears more profitable in early years of the lease and less so later. It will appear less leverage over the entire lease period. When a leaser reports a lease as a financial lease rather than an operating lease, it will usually appear more profitable in early years of the lease. Okay, so this is reading 28, I believe. So we have finished reading 28. We will now go into our next. We will go into our next reading in our next video. Let's not forget I have my show notes in the description. You can go buy my show notes on Amazon. So we will be getting into income taxes, reading 29 in our next reading. I do hope my readings have been helpful, and I hope to see you guys next time. Okay, goodbye.